20-minute trader here giving you easy explanations. Today's video, we'll be discussing the strike price for call and put options. And I will also tell you the biggest misconception about strike prices that almost everyone has. If you don't know what a call or put option is, you need to see those videos first. At their core, call options are a bet that the stock will rise, and put options are a bet that the stocks will drop. If you buy a put option and the stock goes down after you bought it, you make profit. And conversely, if you bought a call option and the stock goes up afterwards, you profit. And the only reason people buy these options instead of the stocks is because you can get significantly more profit using way less money than if you bought stocks. Oh yeah. And you can also lose significantly more with small drops. In other words, options make changes in the share price value more sensitive. And with put options, you profit on a drop, which can be fun. Let's quickly define what call and put options actually are, even though almost no one uses them for these purposes. A call option is a contract that gives the buyer the right, but not the obligation to buy 100 shares of a stock at a specified price, known as the strike price, within a certain period of time. On the other hand, a put option is a contract that gives the buyer the right, but not the obligation to sell 100 shares of a stock at a specified price within a certain period of time. Like I said, almost no one uses these instruments for this purpose, but it's good to at least know what they are. Almost every trader that buys puts or calls just sells them for more or less than they paid for them shortly after buying them, just like stocks. These contracts change hands like a hot potato. That's the real action definition with puts or calls for the vast majority of people involved. It's very rare that someone buys calls and puts to actually go through the motions of buying or selling the underlying stocks at the strike price. Most just pass it along shortly after buying it. But what is the strike price? Most beginning traders think a strike price is the target price that the trader is aiming for. It even kind of sounds like it. If a baseball pitcher throws a strike, it's because they aimed for and hit an exact target. But no, it is not the target price whatsoever. Banish that from your mind. It has nothing to do with that. But go ahead and pitch us a like and strike the subscribe button to help us with the YouTube algorithm. Here's how strike prices work. When a trader goes to buy an options contract, they are asked what strike price they want to choose. It kind of doesn't really matter which one you choose because no matter which one you select, except for strikes that are much higher or much lower than the current share price, the value of the contract will rise or fall based on if the share price rises or falls from the point when you bought it onwards. So get this data, the strike price itself doesn't matter that much. Whichever one you choose, the contract you buy will go up in value if the share price goes up from the time you bought it onwards, and will go down in value if the share price goes down from where it was at when you bought the contract. Strike prices, to the common trader in almost every scenario, really only mean one thing. If you want to lower the cost of a call option contract you are about to buy, you raise the strike price that you select for purchase. And if you want to raise the price of the contract, you lower the strike price. Imagine this. You go to the trade page on your brokerage account and you select the Apple stock. Then you choose call option. Right away, it asks you for what strike price you want to choose and provides a selection of strikes broken down usually by dollars or 50-cent increments. The first one they suggest is the strike price that is about equal to the current share price. So if Apple's share price is $160.40, it'll propose a strike as a default of $160. Then you will look at the current price of the contract. Perhaps it will say $500. If you change the strike price to $159 from $160, the cost of that contract will go up to around $600. If you change it to $161, it'll drop to $400 or so. Higher strikes for call options equals lower price. Lower strikes for calls equals higher price. Put options are identical in behavior but opposite in direction. Lower strikes are cheaper and higher strikes are more expensive. Why would somebody want to buy more expensive contracts, you ask? I'll explain. So first, let's just be very clear what the strike price actually means and how it affects the cost of the option contract. The strike price is the price at which the buyer of the option can buy or sell the shares. It is also known as the exercise price. With call options, you can think of it as a promo code to buy something for a different price than it is on the market for, like a coupon. Let me give you a very simple example. If Apple stock was currently worth $160 per share, you could buy a contract from someone to buy them at only $150 per share, $10 less than it is actually currently worth. That price, $150, is the strike price. The strike price determines the price at which the option can be exercised, always equating to 100 shares per options contract. Think about it. 100 shares of Apple at $160 per share is $16,000. If you have a coupon to buy them for only $15,000, that coupon itself is worth at least $1,000 because you could buy those shares for $15,000 and sell them for $16,000 right after. So you can easily see that the lower the strike price, the more valuable the contract. You could also have a strike price that is so high, much higher than the existing share price, that has very little value. Think about that. If you have a coupon to buy 100 Apple shares for $180 each, but the current price of Apple shares is only $160, that coupon sucks, right? Kind of. The reason it doesn't totally suck is that if Apple shares happen to go up above 180 to say 190, then now that coupon is really valuable. If someone felt that the price of shares of a company was going to go way up, buying such a high strike call option would be a very profitable move when the share price does in fact rally up like that. And as I said earlier, the higher the strike price, the cheaper the contract. So in the example of buying a call option with a 180 strike price, the cost of that contract would probably be something like $20. But when the share price hits 190, that contract would be worth at least $1,000. That's 50 times the worth. Obviously an unrealistic thing. Share prices rarely make that big of a leap. But if they do, and you happen to have a pile of those contracts in hand, you really clean up. On the other hand, a put option with a strike price that is higher than the current market price, the underlying asset is more expensive than a put option with a strike price that is lower than the current market price. This is because the buyer is paying for the right to sell the underlying asset at a price higher than what it is currently worth. So now let's briefly answer why someone would pay for a more expensive call option contract if the profit would be similar either way. If I had $2,000, wouldn't it be smarter to buy 10 contracts valued at $200 each so that it would be like I was renting 1,000 shares for only $2,000? And if the share price rose by $3, I would make like an extra $3,000. And the answer to that is sort of. Number one, the cheaper the contract, the less its value moves or changes in your favor. It's not as sensitive to the share price movements. That share price has to really move for it to create a profit. If you want to geek out on the math for this, I am happy to oblige, but I won't in this video. More expensive contracts respond quite sensitively to the changes in the share price. Number two, with cheaper contracts, you stand to lose a lot more with a share price change that is not in your favor. Specifically, if you buy a bunch of puts hoping the stock will drop and it rises, there goes your stash. Blown away by the winds of fate. And the same with calls. If you buy a bunch of cheap calls for $2,000 total and the stock drops, boom, you might lose $1,200 in one shot. And number three is the matter of fees. The broker is likely to charge you around 65 cents per contract to buy and 65 cents per contract to sell. Cents, you say? I can afford to buy some cents. I'm not sure why you sound like someone from the 50s, but there you go. Well, I say to that, if it don't make dollars, then it don't make sense. Pretty punny, I know. But those fees add up faster than likes on a video of a puppy kissing a kitten. And that one trade of only 10 contracts costs $13 to buy and sell. Do that every trading day for a year and you're down $3,380. And you can't even write off those fees on your taxes. Terms and conditions apply. I'm not a tax accountant, tax attorney, or CPA. Consult your certified public accountant for tax advice. Fees can screw you. So buying fewer contracts overall saves on fees. Therefore, more expensive ones allows for that. Now you know almost everything there is to know about strike prices. I use a method called 20-minute trader, and I explain my system in detail in which I make money trading only 20 minutes per day, taking advantage of the best strike prices for call options. Free course link in the description. And that concludes today's lesson on strike prices. I want to remind you that day trading is risky and my results are not typical. Your success is not guaranteed if you learn with me or on your own. Practice first with paper trading before putting your own money on the line. Do not blindly follow me or anyone else. See you in the next video.